Yeah. Welcome back to Infinite Investors, the home for all new and non-investors. I'm Curtis, and today we have another investment video for you. And I'm going to be talking to you about the free shares that I've earned. I received a comment from BTC Venom. Shout out to yourself. And they asked the question, Curtis, could you go over some of the free shares that you've basically received? He would like to know the value of them and opinion, etc., etc. So I'm going to do a two-part video. In this video, I'm going to talk about all of the ETF free shares that I've received and the fund free shares that I've received, and I'm also going to give you my thoughts and feelings about the specific ones that I've received, and also explain how funds work, how ETFs work, etc., etc., very briefly, because I do have more in detail videos on them, but just in case anyone wants a brief snapshot, I'm going to give a bit of a synopsis on that. And then in part two, I'm going to talk about all of the stocks that I've received, so not the funds, the stocks. So in this video, the funds. In part two, I'm going to be talking about the stocks. So if you want to know more, like, comment, subscribe, help the channel get to 5k subscribers, and we can get the world of investing out to more people in a clear, simple and transparent manner. The first one I'm going to talk about is the iShares Global Energy UCIT ETF. Now, I have received 4 of these over the past few weeks. The current share price is sitting at about £5.86, and this is basically an ETF that's all about clean energy. So the whole thing around clean energy, renewable energy, and basically investing in companies that helps renewable energy. This was actually an ETF that I did consider purchasing not too long ago. Perhaps maybe in later on in 2020 I might actually reconsider it. But obviously I then decided towards the end of last year to focus on growth stocks, particularly in the tech industry. And then that's obviously where my focus lied and where I wanted to hedge my bets for 2020. But as far as ETFs go, I do think this is a pretty good ETF from what I've seen so far. However, I did always want Freetrade to release a lot more stocks and a lot more ETFs, because there are loads of ethical ETFs, there are loads of clean energy ETFs. This isn't the only one in the world, and so I didn't want to kind of restrict myself just to the only one that's available on my platform and put money in just on that basis. But if you look at the performance, what you'll actually notice is something really interesting, or at least I find interesting. 2014 to 2015, 2.29% performance. 2015 to 2016, minus 16%. 2016 to 2017, 20%. 2017 to 2018, minus 8.97%. And 2018 to 2019, 43.65%. And I do believe that this is basically symbolic of, the market trying to react and trying to really understand clean energy. Is it a fad? Is it something that can really take off? You're going to probably have a lot of the oil companies been pushing back at this, but I do think with the likes of Tesla, with the likes of so many other companies, clean energy at this current moment is on that probably convergence point where it's going to start taking off. And that's why I believe that the most recent year's performance has been so good, and I would expect that probably the next 3 or 4 years performance would actually be really good as well. So typically with all ETFs, with all funds, there's a cost, and the cost you're looking for is either called an expense ratio or an ongoing charge cost, depending on the type of fund, etc. This one's 0.65%. I get the question so many times, Curtis, as you can see here, ongoing charge, expense ratio, pretty much the same thing. So I get the question a lot of the time, Curtis, how am I charged at 0.65%? Do they need my credit card details? Do they need my bank details? Am I wiring some money to Nigeria? No, you ain't doing none of that. Basically how it works is the whole value of the fund, they basically take 0.65% off of the value of the fund each year. So you don't physically see that money, but it does effectively come out of your returns. Think of it like a tax almost. That's probably the best way and the most simplest way I can probably describe it to you. All funds typically tell you, what they're focusing on. So what asset class. So this is equities, which basically means it's going to be stocks, it's going to be companies, etc. It will tell you the net assets. This is the amount of money and the liquidity it holds. Typically, the larger the number, the more liquidity, so the easier, and it's easier to get in and out. And obviously, if it's growing in liquidity and growing in volume in terms of assets, then probably your share price and your valuation is going to grow. Some pay dividends, some don't. Ones that do pay dividend, they will tell you the frequency. So this one is a semi-annual dividend, which basically means it pays you a dividend twice a year. And then obviously it's got a whole bunch of other information, obviously, which, I probably should do another video if I want to go into each of those things in, a lot of detail. But yeah, overall, I don't see anything specifically wrong. When you go to the holdings, you see what stocks it hold. One of my recommendations to you guys is that anytime you're buying an ETF, definitely spend a little bit of time just looking at the top 10 holdings, just having a flavor. You don't have to do, copious amounts of, Warren Buffett-esque analysis. But I would say, definitely get a flavor of the top 10 companies. Who's the CEO? What do they do? What do they get in? How's their performance been over the last X amount of period? What types of products and services do they do? What markets are they in? Just to try and get a flavor of, where most of the asset allocation is. And at least that way you know what you're investing. That's one problem I do have with ETF investing as a practice, is generally people see it as a way to be lazy and to not then actually understand what they're investing in. And I just don't think there's any real good enough reason for that personally. So yeah, try and have a look at that. It tells you, what exposure breaks down. I really love iShare ETF specifically because iShares has this really lovely website, and you type in your ticker symbol and it gives you all of this information in a really clear, simple, easy way. But then you've got all of the documents as well if you want to look at that in more information. But yeah, overall, I'm pretty happy with this ETF, with this free share. Obviously, like I said, it's about £5.86 at the moment is the share price. So yeah, it's not the most expensive from a unit standpoint. And potentially it could be a good ETF, but in terms of me adding more money to it, not for me at this current juncture. I will definitely be waiting until Freetrade launch a whole bunch more, and then obviously I can start to compare different clean energy ETFs, different allocation, different businesses, give it some time to work out which ones I basically like. But to get this for free, pretty cool, I would say. The next one that I've got is Invesco Perpetual Income and Growth. Now this, I've got 7 free shares of this at the moment. Each share currently is worth £2.94, so it's pretty small in terms of valuation. And then obviously my overall holding is like sitting at £20 or something along this lines. Now this is, as you can see from the title, an income and growth fund. So what that basically means is that this fund is focused on giving you an income, which is obviously going to be a dividend payment, but also trying to grow the fund as well. So it tells you, who the fund manager is. It has this lovely pretty picture of Kieran Mallon here as well. And then obviously it shows you the fund performance over the past period. So you can see 1 year, 3 years, the 5 year, etc., 10 years, and obviously what the sort of annual compounded rate is. So what that basically means, an annual compounded rate of 9.32%, which is pretty good, which I think is pretty good. I don't think that's beating the S&P, but it's beating whatever benchmark this is that they've basically kind of set. I think they set targets for the fund, and that's basically what that is doing. Then it tells you some of the holdings. Obviously, it'll always tell you what the top 10 holdings and what that percentage basically makes it up of. You can see some names here that you'll realize: Experian, the whole credit expert; GlaxoSmithKline, that I know some of you guys invest in; Inform is a company I've heard of before; British American Tobacco. I hold Imperial Brands, but I know a lot of you guys hold British American Tobacco. Actually, a lot of you guys have spoken to me about Pennon as well. And then obviously it gives you the industry breakdown in terms of what it actually invests in from a sector perspective as well. So you get all of that basic information. And towards the end of this video, I'm going to tell you the things that I personally will look for when I'm looking at a fund of this nature. The next one I get is Standard Life Private Equity Trust. Now, Standard Life Private Equity Trust, I've received 3 shares of this. The current share price at the moment is £3.64. So obviously the total value is about £10.92 at the moment. And again, you get similar information. You can see what the breakdown has been over the past years in terms of performance and so forth as well. So what you can basically see here: 3 months return 11.7, 6 month 11.5, 1 year 22, 3 years 13, 5 years 17, section 9.4. Me personally, when I see things like this, listen, I don't think it's bad necessarily, but I do think it goes to the type of investment style that you've got And me personally, I'm not great with funds, in the sense of it's not something that I like investing in as much, apart from the S&P 500, because I just think that's something everyone has to hold. I think with funds, personally, I like to kind of pick my own stocks. But don't get me wrong, there are many people that invest in growth funds or invest in normal mutual funds, and have a fantastic return. It all depends on your goals and what you're basically focused on as well. So obviously you can see what the net assets are, etc. And then when you go into holdings allocation, here it has this kind of nice infographic which basically tells you the portfolio diversification, type of fund, the percentage you can potentially receive when it matures, and obviously the sectors that it basically goes into as well. The next one is JPMorgan Europe Smaller Companies Fund. So basically this fund invests in small companies within Europe. Basically it does what it says on the tin, effectively. With this one, I've received 3 shares of this, and it's about £3.63 is the current share price. One thing I haven't spoken about yet in this video is you will always get a risk profile as well. So obviously the higher the number is basically the higher the risk, but the potential of a greater reward. The lower the number is the lower the risk, but obviously, you know, the lower the potential reward, but obviously it's not risk free. Here you can see the ongoing charge is 1.61%, which I think is obviously extremely expensive. That's, you know, over, you know, nearly like, well, let's just round up, nearly 2% of the value of the fund is going to basically, you know, leave. So obviously just think about, if you got 8% performance, then obviously you'll be getting 6%. If you've got 3% performance, you'll be getting 1% effectively. That's the way that I like to look at it, just to kind of keep it simple in my mind as well. Obviously you get the previous performance here. You can see that 2018 wasn't a good year, but 2019 has actually started to do okay. 15% return, 27.99% return, 14.3, 28.97%. It pays a yield of 0.68, and obviously it gives you some of the dividend schedule. Again, I don't want to bore you and go into this too much detail. And then you can see some of the holdings here. A lot of these holdings, I don't know a lot of these companies. I mean, I've heard of Ipsos, I've heard of Arcadis actually, but these are all small cap European companies. If you think of like the AIM stocks for the UK, or like the FTSE 350, these are those types of smaller stocks. So obviously with those stocks you potentially might get greater returns, but obviously there could be, you know, less liquidity and a little bit more risk as well. And what's interesting with this, obviously it gives you the country allocation as well, and tells you the country allocation, which I think obviously in Europe is very important, because, you know, Europe is a very diverse place. A lot of economies in Europe behave very, very differently. Germany is obviously a much different economy to the likes of Greece, as an example. So it's worth definitely knowing what companies the stock is actually holding, and obviously, you know, it gives you that information and so forth. The next one is JPMorgan American Investment Trust, a little bit less on the risky front, etc. And then here again, the performance is here. I'm not going to go read it out. You can go check out for yourselves. I'll leave the link in the descriptions, etc. But one thing with this is that it's got some of the names that you guys know about: Micro, Hard, Alphabet, which is obviously Google, Capital One, Pineapple, Bank of America, Delta, MasterCard, United Health Group. These are some of the top 10 holdings, and obviously some names that you really know. With a fund like this, you definitely should be benchmarking it to the performance of the S&P 500 and working out, you know what, is this better, is this worse than the S&P 500? The reason, one thing to bear in mind is that typically with most funds, what you're going to have is a fund objective. So any fund that's basically created, the fund manager is going to have an objective, and they're going to state it, and they're going to be clear that this fund is targeting these types of stocks with the goal to try and increase the value of the fund by 10% year on year, or with the goal to pay a return of 8%. Accumulative growth, like accumulated return, or, you know, this fund has you know, we want to pay out a yield of XYZ, whatever it is. They're going to have an objective that they're going to be trying to achieve. So they're obviously actively managed, typically to try and beat a typical index like an ETF such as the S&P 500, etc. One thing you need to bear in mind with funds is that it's not in real time in terms of the share prices. So what tends to happen is that At the end of each day, it gets calculated their assets and their liabilities and what their number of outstanding units effectively, and then it calculates what the value of that fund is. So that's done typically once at the end of each day. Some funds is weekly, monthly, it all depends. Funds are quite a murky place, so you need to obviously look into the intricacies, but I'm just going to give you a brief overview. Maybe I'll do another video where I go into it into a bit more detail. But effectively, at the end of the day, there's a closing price, and that is the closing share price. Whereas with the typical ETF or with a typical stock, you see the share price moving consistently throughout the day. But because of that, there are quite unique factors that's actually quite advantageous with funds. So you've got the whole concept of trading at a premium or trading at a discount, and what that basically means is that if the last day's closing price will say 100, that you might find out that the fund is trading at a premium based off its previous day's closing price. So if you get in, actually you're getting in a little bit more expensive, or it might say it's trading at a discount. So everything that's going on with the coronavirus situation, a lot of funds are basically trading at a discount, which can potentially be a good thing. So it's, you know, it's worth noticing. Now you've got some funds that are actually a little bit unique. So if you go back to, for example, this Standard Life Private Equity Trust, one thing that's quite unique with this one versus, say, you know, JPMorgan, smaller companies, is all of the companies this one invests in, and all of the companies that American Investment Trust invests in, are actually on the stock market. So these ones are companies that you could actually go and invest in directly yourself. You can go and invest in Capital One, Alphabet, Microhard, etc., etc. With this one specifically, this is a private equity trust. So the whole purpose of a private equity trust is basically a fund that invests in unlisted companies, typically early stage, but they've got a goal and a purpose to create, you know, long-term value, hopefully see those companies floated, and then obviously sell them off at a higher price. So if we go back to some of the holdings that you can see here, what you'll find with this one actually is pretty unique, is that the holdings, rather than actually being companies, they're more private funds. So it's basically a funds of funds. So it's like a fund investing into a group of funds that's doing a specific purpose, which in this case is private equity. But if you were to basically Google any one of these funds, for example, like let's say Bridgepoint Europe 5, for example, what you would find is, you know, how much that fund is worth, typically where they're focused. It might be Norway, Sweden, you know, a specific area, and what type of businesses they invest in and what type of return they've basically been seeing. So it's a very interesting world, and it can get very murky, and that's why I like to just keep it clean and just invest in my own stocks and pick my own stocks, just because, you know, you have to kind of really keep track. I remember when I first started investing, I invested in a company called Man Group, which is basically an investment trust similar to this, to be fair, and Man Group would invest in a whole bunch of funds, and I would always find that the performance of the stocks that I picked versus Man Group was completely different. It was always better. Not to say that I was better or smarter than Man Group, maybe it was a little bit of luck, but obviously I'd invested in 9 other stocks and they were always better than Man Group. And I just think, because obviously you're investing in funds, and then you've got the charges and the value and all of the other stuff going on, it can get a little bit murky as well. But you know what, funds is still definitely a good thing to look at. One thing that we talked about a little bit earlier on as well is the net asset value as well. Net asset value is definitely something to be mindful of. So net asset value is simply the price of one unit of a fund. Effectively, it's like, you know, the share price of a fund almost. So the way it's calculated is the assets minus the liabilities divided by the number of units outstanding, which kind of like in the stock market world is the number of shares outstanding, and effectively that's calculated on a daily basis, a monthly basis, and a weekly basis. So understanding the net asset value will basically then let you know whether or not, you know, how well the fund is basically performing. Is it worth buying? Is it cheap? Is it expensive, etc., etc.? So there's, you know, a lot of information about that online, which is very easy to basically Google and find out anyway. But what I will end this video with saying is that obviously with all of my free shares, the ones that come through, I just let them sit there. I let them sit there. If they grow, they grow. If they fall, they fall. It doesn't really matter. It was free, obviously, given to me. And if they do grow over the long term, then obviously I've just increased the free share value that Freetrade gave to me. But one thing I will say is there are probably 4 things that I personally would look at if I am choosing to invest in a fund. these are the things, and this is whether it's an ETF or whether it's a private fund, a mutual fund, or a growth fund, whatever it is, whatever type of fund it is. If it's a pool of money that's going into different businesses and I'm going to invest into that, there's probably four key things that I would look at. The number one is obviously the cost. And what I mean by cost is not the share price, but what we talked about, the ongoing charges or the expense ratio. I think that's a really important factor that a lot of investors that I've seen from my research can lose a lot of value by going into very expensively managed funds. Now, the reason why these funds do charge a cost is because it costs money to produce information. It costs money to build this website. It costs money to manage the fund, to pay the salaries, to put rent into the building. To market the fund. All of that costs money. So effectively they look at the whole value of the fund and they think, you know what, we need to take 0.65% in order to keep this fund going and to keep this fund ticking. Effectively it's just the cost of doing business. My S&P 500, just as a comparative amount, is 0.07%, 0.07. Here, this is 0.65. And we talked about some of the other funds that we showed, which was obviously like 1.61 or 1.65, etc., etc., etc. So obviously, it can get very expensive. Probably the most expensive I might have seen is probably around the 2 or 3%. I can't remember. I haven't seen much more expensive than that. If there are, then obviously 100% will stay away from it. But cost is very important. The second thing is holdings. I think obviously you're investing in a fund because that fund is focused on a certain geography or a certain type of investment or a certain industry or a certain asset class that for whatever reason is important to you. So if you are interested in this specific asset class or whatever, you need to understand what the holdings are. So like I said earlier on in the video, I definitely would look at the holdings, understand the performance of some of those holdings individually as individual businesses, so obviously what you're investing in. The third thing I like to look at is past performance. Like we all know the saying, past performance is not an indicator of future performance, but for me it does tell a story and it can paint a picture and you can try and understand the direction. If the past performance is continually growing up year on year, then I think as a fund, the way it's managed potentially can be good. If it's got quite a choppy, volatile year-on-year performance, 1 year up, 1 year down, 1 year up, 1 year down, then obviously there's going to be some external factors that's really causing pressure onto the fund, and it's worth trying to understand what those are and whether or not you feel the fund can basically survive that. If the fund is going down in value, then probably they'll close the fund at some stage and just return money because they can't, you can't keep on running a fund that's just continuously going down in value. So it's definitely worth that. And it's worth seeing actually with the cost involved, etc. Is it worth it? One thing that I find is that with funds, sometimes it's better for wealthy people that already have a lot of money to just basically put in and leave and let it be managed over a period of say 10 years, rather than people that might be say dollar cost averaging and adding money. But to each his own. I think it all varies. The last thing is risk. I think risk is important as well. So if it is a 4 or 5 or 6, etc., understanding that you are going for a riskier investment, so that you can see the risk profile here, and understanding your risk levels, because obviously if things don't go well, then obviously you need to be clear on what to potentially expect with the type of funds that you're going in. What I typically find is that if they are bonds, or if they are typically bonds, you would find fixed income stuff would be in the lower regions here, whereas obviously a lot of the equity stuff will start to become in the higher region. And then obviously depending on the sector and depending on the volatility of the equity, so whether they're small cap, etc., depending on the region, etc., it will tend to go a little bit higher and a little bit more risky. So again, it's something worth looking into. But yeah, those are the 3 shares that I've received in terms of funds. I'm going to hold them, see what happens. In part 2, I'm going to talk about the stocks that I've received, so look out for that. And then obviously I will let you know, or YouTube will let you know when that's live. But yeah, if you've got any questions on anything that I've mentioned, obviously I just do this live, I shoot this in one take, so something might not have been clear, let me know in the questions in the comments and I will respond as quickly as I possibly can. Other than that, take care, have a good weekend. Hi. Have a good evening, and I will catch you next time with another investment video. Take care, guys. Peace.